Police clashing with demonstrators on Sunday, demonstrators who were angry that some rural banks have kept millions of dollars frozen since April. At the time, the banks said they were upgrading their internal systems, but customers say they've heard nothing from the banks about the matter since then. The protest was among the largest in China since the pandemic.
From supply chain disruption due to lockdowns to inflation brought on by poor policy, the standard of living for people across the world has drastically declined in the past 3 years, and as a result, the housing market has suffered greatly. But why exactly are housing prices increasing so quickly, and how in today's market can a young adult climbing the ladder of success afford the median sale price of a home? Join us as we discuss why home prices are so ridiculously high in the United States today. Homes in the United States sold for a median price of $388,100 in December 2022. That's a 1.2 increase over the same month the previous year. However, on average, when you compare the 376,319 homes sold in December 2022 to 594,572 homes sold in December 2021, the number of homes sold was down 36.7% year over year. And it's true that high mortgage rates, persistently high property prices, and economic uncertainty are pushing many home buyers, particularly remote workers, toward more affordable places at a previously unprecedented rate. The national average 30-year fixed-rate mortgage rate is at 6.4% and up 3.3 points year over year. And according to data released by the National Association of Realtors on Friday, existing home sales decreased by 4.08 million in November to a seasonally adjusted annual rate of 4.02 million in December. Since November 2010, which was one of the worst months of the housing bust, that was the lowest sales pace ever. So, based on home prices, median family incomes, and current mortgage rates, the NAR's affordability index increased from a multi-decade low of 91.3 in October to 95.5 in November. Lower values signify less affordability. For comparison, during the 12 months prior to the COVID disaster, it averaged 162. Feels like a pipe dream now. A quick calculation reveals that the NAR index for January would be around 106 if family earnings continued to increase at their current rate. The median home price remained steady from December, and the mortgage rate was set at 6.15%. If the typical mortgage rate dropped to around 2.6%, it might return to its pre-pandemic level of 162. Another would be a rough reduction in price or a roughly 50% increase in household incomes. Since affordability indicators were historically extremely high before the pandemic, it is likely that homes won't need to be quite as affordable in order for the housing market to rebound. The United States' still limited housing supply helps to support the market in various ways. Additionally, a substantial number of Americans are now transitioning, with the largest 5-year cohort in the United States as of 2021 being between the ages of 30 and 34, and the second largest being between 25 and 29. Because they don't want to give up their comparatively low mortgage rate, many homeowners are likewise hesitant to move. Fewer people were looking to buy homes to move into 8 of the top 10 migration destinations in the fourth quarter compared to the previous year. The two most preferred locations, Sacramento and Las Vegas, both experienced net inflows of approximately 5,500 in the fourth quarter, down from approximately 6,500 a year earlier. Phoenix, the 5th most popular destination, saw a decrease in net inflow of more than 8,000 during the fourth quarter to roughly 4,000. Due to the influx of remote employees, property prices have increased in well-known cities like Las Vegas and Phoenix since the epidemic began. Although they are still far less expensive than in locations like the Bay Area or New York, the typical home in those locations is less expensive than the typical home in the most common location in 8 of the top 10 travel destinations. For instance, Sacramento's median sale price of $540,000 is considerably less than San Francisco's typical sales price of $1.4 million, which is where most out-of-towners arrive in Sacramento. Cape Coral, Florida, and Northport, Sarasota, Florida are the exceptions, with Chicago as the top origin. No one can deny the weather all year round in many of these places is lovely. 5 of the top 10 destinations are in Florida, and all 10 are noted for their sunny temperatures, so move with your sunscreen. Renting as a better option. But these days, renters have many benefits to consider over home buyers. In the vast majority of the nation, it is more affordable. In roughly 95% of US counties late last year, a survey of 222 countries by real estate data supplier Atom found that renting a 3-bedroom home required a lesser percentage of salaries than owning one. That represents a significant change from a year ago when 60% of countries had higher ownership affordability. But there is one disturbing stat. In many parts of the country, rent costs are rising more quickly than housing prices. But the analysis found that higher interest rates contributed to a roughly 50% increase in monthly mortgage payments. According to the Executive Vice President of Market Intelligence, Rick Sharga, there has been a very dramatic movement in affordability measures for such a short time. Brooklyn's Kings County, New York, includes both renting and owning, which together accounted for 126 of the average local pay. Nevertheless, there are a lot of regional variances. In the majority of the US, renting and owning consume more than a third of income as a result of both of their sharp price increases. Interest rates. The interest rate is a crucial element that cannot be overlooked when determining how you might be able to buy a home. Since the Federal Reserve increased the federal funds rate over 6 times in the past year, investors have not exactly received a healthy dose of confidence boosting from the institution. Due to this, consumer borrowing costs, including mortgage borrowing, have gone up. The average interest rate was only 3.4% as of January 2022, which isn't too bad. However, if you fast forward to October, you'll see a 6.9% figure. The ramifications of that huge surge have spread to the property market as well. Both purchasers and monthly mortgage payments have been impacted by the Fed rise. The rates were broken down as follows by Derek Amos, a senior mortgage loan originator with Mutual of Omaha Mortgage. With rates currently hovering around 7%, a buyer's monthly mortgage would increase by nearly $8,000. Unfortunately, little looks to change for the better. The bad news is that, at least in the near term, rates are anticipated to continue increasing before they start to fall once more. On Wednesday, 14th December 2022, the Federal Reserve raised its benchmark interest rate to the highest it has ever been since 2007, according to the overall assessment of the current circumstances. It has been noted by Derek Amos that the rates will inevitably fall. However, it's increasingly likely that they'll get close to 9% before that happens. The initial prices from 2021 won't be returning anytime soon. That much is certain. But there's one other factor to consider. Constrained supply. The limited supply of homes is a major cause of home price inflation. The United States is short of almost 4 million homes according to Freddie Mac. In fact, since the 1960s, we have never built as few homes as we did in the 2010s. That's because of severe zoning regulations. So we aren't utilizing the land to its full potential in some of the most coveted residential areas. And since we don't have enough housing, home prices roughly reflect what well-off people are prepared to spend. Simply said, only the wealthiest third of families would be able to purchase a home if there are 10,000 properties available for sale in a community and 30,000 people are interested in purchasing. Because they don't have as many resources like money or credit to win a home, the other 2/3 fall short when they try to compete. So how would things get better from here? The fact is that after a low point in the second week of November, the housing market has started to rebound. Although we're not yet out of the woods, more people are starting to look at buying a home. Home tours and service requests are down 23% and 27% respectively, compared to a year ago. However, this is an improvement from the November low when both were down 40%. Increased home sales are already a result of this. In several cities, including Richmond, Virginia, Central Florida, and Seattle, Redfin brokers claim that bidding wars have returned. Homebuyer demand is still lower than it was at the beginning of 2022. But the market has entered a new stage and reasonably priced listings are selling swiftly. The average 30-year fixed mortgage rate has dropped to 6.15% from its peak of 7.8% in November, which is the largest 10-week decline since 2009. Mortgage applications are up 28% from early November as a result. Due to this, the typical home buyer's mortgage payment has decreased by 10%, or roughly $180 since the crash. On a seasonally adjusted basis, pending home sales increased by 3% in December compared to November, marking the first month-over-month growth in 14 months. We hope for more positive readjustments in the future. If you enjoyed the video, leave a like, share, and click the bell icon so you stay up to date on all happening around us. See you next time. Bye!